First of all, what's happening in the mortgage markets, what's happening in the stock market in the United States, is exactly what we've been forecasting, what I've wrote about in my book, Crashproof, what I've been writing about in my commentary for years. So none of this is coming out of left field. All of it has been forecast by me and is completely consistent with the investment advice that I've been giving out over the years. Now, first of all, the mainstream economists and the media are trying to put a very good spin, a positive spin on what's going on, and pretending that what's happening in the subprime mortgage market, what's happening to some of the people involved in that industry, is a small blip. It's nothing to be concerned about, that the overall fundamentals of the U.S. economy are sound. Now, nothing could be further from the truth. The overwhelming underlying fundamentals for our economy are not sound. The problem is, for years, and mainly since the bursting of the dot-com bubble, our economy has basically been based on consumer spending. And consumers have been able to spend only to the extent that they've been able to borrow money. A lot of that has been financed or collateralized by their homes. And as people's real estate increased in value, they had a lot more wealth, theoretically, and that gave them the impetus to spend more money. And as a result of all this real estate wealth, people, particularly Americans, decided that they didn't have to save anymore. And there was a lot of excess spending associated with real estate wealth, and a lot of Americans availed themselves of adjustable rate mortgages, which meant that their mortgage payments, which for most homeowners is their largest monthly expenditure other than taxes, by artificially and temporarily minimizing that payment, that freed up a lot of additional money for consumption. And so we had this huge consumer-based economy where consumers borrowed money principally from foreigners and spent it. And that's what kept this economy going. And when the analysts on Wall Street point to how solid the fundamentals are, they're looking in the rearview mirror. They're looking at a time period when Americans could still borrow money. Well, those times are going away because the foreigners or even the hedge funds who have been providing that credit are now finding out that they're not going to get paid back, that they lent Americans too much money. And so it's not just subprime. That's the tip of the iceberg. Americans who have good credit, who have prime mortgages, they have adjustable rate mortgages. These mortgages are going to reset. They're not going to be able to make those payments. Home prices are going to fall, not just for subprime borrowers, but for everybody. And so consumer spending is going to drop dramatically. A lot of people are going to lose their jobs. The economy is headed for a severe recession. It doesn't matter what the Federal Reserve does. It doesn't matter what people on Washington or in Wall Street are saying. That's unavoidable. And so when that happens, the U.S. dollar, which right now is teetering on record lows, I think will crack through the floor and drop precipitously. This is the decline that we've been anticipating for years. And so it's during times where the dollar declines that it's most important for Americans or investors to have their wealth outside the United States in foreign stocks, and stocks that are denominated in the currencies against which the dollar is losing value. Now, what's happened recently, and maybe has caused some concern and is really the motivation for this message, is that in the recent decline in U.S. stocks, many of the stocks that my clients own at Euro Pacific Capital have also declined. In addition, some of the currencies that we have exposure to, particularly the currencies in Australia and New Zealand, have also declined. And that has caused some people to question the wisdom of what we've been doing. Sure, we've been able to generate some substantial profits over the last 8 years, far more so than people have been able to achieve by investing in the domestic markets. But most of my clients have assumed that our portfolios would be the most lucrative or the most beneficial during times of distress in the U.S. market. However, recently the U.S. market has declined and our portfolios have declined as well. Now the question remains, is this something that's going to continue or is this an aberration? And it's my feeling that it's the latter, and here's why. What's happening right now is really causing a lot of over-leveraged speculators to have to reduce those positions. You have a lot of hedge funds that operate with a lot of leverage, that own a lot of the same stocks that we've been buying. I mean, no wonder. They've been doing really well. They've been appreciating. They pay high dividends. They're very attractive to hedge funds who are employing various carry trades, where they borrow in a low-yielding currency such as the yen and invest in higher-yielding assets, particularly some of the assets in Australia and New Zealand. And so as these leveraged speculators have been caught, as the assets have moved against them, they've had margin calls. They've also had requests for redemptions from their investors. So that has caused a lot of selling into the market. Also, there's a lot of nervousness. A lot of foreign banks and investment firms own U.S.-denominated mortgage-backed securities. And people are starting to question, what are these securities really worth? And it's causing some bit of panic around the world, and it's causing a rush for liquidity. And of course, these problem loans or these problem assets that are backed by mortgage-backed securities, the market for them is drying up. So if people need liquidity, they can't necessarily sell those assets. They have to sell something that people actually want to buy. And some of those assets are the stocks that we own. So what's really happening to a lot of our foreign positions is not a reflection of what's happening with those companies, the prospects for their earnings, but it's really a function of the weak or the position of the shareholders who are looking for liquidity and are trying to raise it in a hurry. And in that environment, people are not necessarily stepping up to the plate to buy and get in front of a freight train, so you have a lot of sellers and very few buyers. And so prices have declined. But I don't think this is a cause for concern. I don't think these price declines are permanent. I don't think they're real. I think they just simply represent the low prices that people who are forced to sell are unfortunate enough to have to accept because they need the money right away and they can't wait for a better price. But ultimately, and I think this is the key, the reason that foreign markets are in trouble right now, or the reason they've declined, is because of losses that they've incurred by loaning money to us. Right? So it's an American problem. And what our creditors are learning is that it doesn't make sense to invest in the United States, to lend money to Americans. And it's not just mortgages. We've been collateralizing consumer debt in all sorts of forms, not just mortgages, but auto loans are securitized, credit card loans, all sorts of loans where people go into a store and they buy furniture, they buy appliances, and they don't have to make any payments or any interest until January 2009. All of this is made possible because Goldman Sachs and Bear Stearns and Lehman Brothers are able to buy up all that paper, securitize it, and sell it around the world. And Moody's and S&P are willing to slap high credit ratings on it. But I think what's happening now is people around the world are going to question and rethink the wisdom of loaning money to Americans who are already hopelessly in debt and who are running a huge trade deficit, current account deficit. And so this real problem that we're seeing is not a problem for the global economy. It's a problem for our economy. And ultimately, I do think that the foreign markets are going to decouple from the U.S. market. There still is a conventional wisdom that, well, if we sneeze, the world is going to catch a cold. That our economy is vitally important to the growth of the rest of the world. And yes, if I'm right, if we do have this massive recession, that it's going to hurt the rest of the world even more. And I think that's a bunch of nonsense. And an analogy that I have in my book, if you haven't read my book Crashproof, here's a copy of it. And everything that I'm talking about is in this book. And in fact, there's a chapter in the book on the real estate market. And when I wrote it, it was a forecast. Now it's a history lesson. But there's a lot of other information in this book that has yet to come true. So the key is to find out about these things in advance, not wait until after the fact when it's too late to do anything about it. But in the book, I have an analogy going back to the U.S. economy and the Second World War. And I wrote about this too. During the Second World War, America had 10 million men under arms fighting a war in Europe and Asia. And our factories were busy 24/7. They had 3 shifts, but they were making bombs, they were making ammunition, and all sorts of things for the war effort. So we had an economy that was dependent on fighting this war. Now, using modern economic thinking, there would have been some kind of financial disaster in the United States should we have ended the war. If we had economists back then, they would have advised Truman, you can't go into Normandy, you can't go into Iwo Jima, because we're going to wreck our economy. We need this war. We'll think about all the soldiers who would be unemployed, or what about all the factories that are making bombs? What are they going to do? Well, the reality of it was, while we were making all these products to fight the war, at home we were sacrificing. We were rationing consumer goods. I mean, our peacetime, our civilian standard of living was diminished during the war because we had to free up resources to fight it. The same thing is happening in Asia. People don't understand that America is not a benefit to the global economy. It's a burden that they bear. Right now, goods are being rationed, theoretically, all over Asia because those goods are being made available to Americans instead. By artificially suppressing the value of their currency, Asian governments are in effect rationing consumer goods because goods that would normally be affordable in Asia, particularly China, are not. They're affordable here. And so the Chinese are working not to fight a war, but to prop up the American economy. And I think once the world recognizes this and allows the dollar to collapse, they're going to understand that the cost, the giant subsidy of our economy of 300 million Americans who aren't producing enough, that there's a huge cost that's exacted from that subsidy. And that when they understand this and let the dollar collapse, all of a sudden, all these manufactured goods that are coming to America are going to stay in Asia or in Europe. They're going to be there for their own citizens to consume and enjoy. And instead of having to take all their savings and lend it to us so that we can remodel our kitchens or buy big screen TVs, imagine all those savings being available to entrepreneurs and businessmen to be invested in capital formation. I think you're going to see a boom in the rest of the world when they finally stop subsidizing the United States. So what's happening now is just the beginning of all these pieces coming together. And so rather than being shaken or being nervous based on what's happening, and if any of the clients are seeing some of their stocks that have gone up for years finally taking a 10 or a 15% drop, don't be nervous about it. This is a great opportunity for anybody who still has funds in U.S. dollars to commit them to global markets, for people who haven't as of yet opened up an account with us to do so, and to do so during a time where there are some distressed owners of these assets who are willing to sell them at what really amounts to bargain prices. Now don't be confused. The U.S. market has dropped as well, but there are very few bargains there. I mean, the U.S. economy needs to, is in trouble. Our fundamentals are lousy, but the fundamentals for the global economy are much, much better. And contrary to the conventional wisdom, those fundamentals will improve when the world no longer has to support the United States. And we can look forward to the time in the future when America is once again a viable part of the global economy, where we're contributing, where we're producing and exporting and saving, not simply borrowing to consume. One day we will return to our traditional roots, but that day is not now. And we need to prepare for that, and we need to understand that there is a major financial disaster in our futures, and we have to protect ourselves, and we need to avail ourselves of the opportunities that we have today, again, to buy some of these stocks and to buy some of these currencies that have been temporarily hit, but which is not consistent with the long-term fundamentals. And again, everything that I'm saying was predicted, and I wrote about it in my book. And again, if you haven't read Crashproof, I would urge you to pick up a copy. And it's great too for any of your friends or relatives who you talk to. If they're not really sure about these problems, if you've been talking to them and they can't really connect the dots, this book will help them do that.